had a trader write to me a few years back, very frustrated, telling me he kept getting stopped out 1 tick, 2 ticks, a handful of ticks before the market turned right back around in his favor. And this happened over and over again, the same pattern. When he sent me his chart, I understood immediately what was happening to him. He wasn't reading the market wrong per se. He was reading the wrong thing entirely, the big picture. He was drawing his zones based on what looked clean, a nice flat line, a level that bounced once, something that looked very tidy on the screen. But the market doesn't care about tidy. It cares about who actually transacted at that price and where they got stuck doing it. And after 3.5 decades of doing this, I can tell you the single biggest gap between retail traders and the desks I used to sit on or near is not intelligence, it's not effort, it's this one idea. Price does not move because there are more buyers and sellers alone. There is a buyer for every single seller. Always, it's a matching mechanism. What actually moves price is the imbalance between orders that are willing to wait and orders that are not willing to wait. I remember being on a trading floor early on, watching a desk absorb size in a stock that the screen made look perfectly calm. Far from it. From the outside, it looked like absolutely nothing was happening. But from the inside, that desk was quietly eating through all the offers above the market because somebody big needed to get long and they wanted in now. That moment changed how I look at every chart. Here's why that matters to you. An institution cannot place a massive order and have it fill at one price or even one time. There simply isn't enough liquidity, right? Orders waiting there. So the order walks over the book, level by level, consuming whatever is available till it's done. Who's played Pac-Man before? It's kind of like that. And that walk is what creates the sharp, almost violent move you see on a chart that otherwise looks really calm 1, 2, 3 candles earlier. Size leaves an impression, size leaves a mark, but it's not always easy to see. It has to, right? Because when you're talking about size, you're not always going to see it in price. You're going to see it in volume. And those marks are what we can call supply and demand. Now, hold on one moment, because every year I've noticed, every few years, there's going to be a reinvention of terminology. So if you and I were together when I was trading in the late 80s, we would have called it a floor and a ceiling. Fast forward about another 8 or 10 years, support and resistance. Fast forward another 10 years when level 2 and depth of market came out, the new jargon was bid and offer. Fast forward now, you'll see a mix of all that jargon, and more commonly it's called supply and demand. What is supply? Supply is sellers. Supply is resistance. Supply is the offer. What is demand? It is buyers. It is a floor. It is support. So regardless of what kind of language you're using, what I'm going to teach you here will apply. Now, it's not because some indicator told me, but because real money got stuck doing real business at that price, and they may not be finished. And I say got stuck is, remember, they have to get these orders filled, which serves you and I. So what does one of these actually look like? You're hunting for a tight base. Charles Dow, 120 years ago, called it accumulation. And it's usually a handful of candles that don't seem to be moving at all, but under the surface, like an iceberg, there's volume happening. After that, you'll see this tight base rapidly expands, right? And that move is followed by a strong, decisive push. A lot of momentum traders love to trade that. But really, the base is the opportunity. The base is the footprint. The push away or out of the base is the institution finishing what it had started, or at least getting most of what they needed filled. I've marked thousands of these by hand over the years, long before charting software did any of this. Now, all this stuff can be automated, which is great. A small basing candle or series of candles, usually it's going to be a series depending on the time frame you're looking at. Intraday, there'll be more candles. Daily, there'll be less. Weekly, there'll be even fewer, right, because of the interval. But you're looking for a base, and that base is what's going to form before the strong move. That would be a demand zone. Right? So if you're talking about support, that basing is happening at demand. If it's resistance, that basing or that sideways accumulation is happening at, you guessed it, resistance. These basing candles before the strong move is marking your either supply, again, resistance, or demand. Now, remember, I don't want to be outside the overall market structure. I'll look for supply or resistance when I want to be short or long puts. And I'll look for demand or support when I want to be long calls. It's really simple once you start overcomplicating it with too many indicators that aren't measuring the right thing. What's the right thing? Volume and also a range. So here's two tools that I like to use. You can use an anchored volume weighted average price. You can use a label. I like to have labels on my screen that mark the average volume over the past 21 or 30 days. Also, you can use really classic tools like a Darvis zone, which automatically finds support and resistance and will oftentimes identify that base. Institutions will often come back for unfinished business. So they might come back to that level, fill again. So this is why chasing the momentum is going to cause you a lot of pain. You remember where that base is, buying, might move higher, might come back down to that base, might move higher again, might come back down to that base. Remember that coming back down to the base fill is what we're looking for. It's an exhaustion fill, and that's usually where the institutions are going to be. Now, which zone you trust matters just as much as finding one in the first place. One thing I've noticed across decades of doing this is that traders love to draw zones on, say, a 1 minute and wonder why nothing respects them. Smaller time frames hold smaller orders. So if you're looking for big moves, my favorite is going to be the 4-hour or the daily chart. That's going to carry a lot more institutional size, institutional weight, as opposed to a 1-minute chart. If I'm day trading, I slow that down to a 5-minute chart. But I know that might be a move that can last 20, 30, 40 minutes, maybe the session at most, right? The longer the time frame, the longer the time horizon or follow-through window. And I've learned this the hard way early on. Trading tiny time frames, tick charts, 1-minute charts, and getting chopped to pieces in noise that had nothing to do with real positioning. So now I work from the top down. If I want to have a move that might last 2 to 10 days, I'll do that on a daily chart. If I'm looking for a move that might last 2 to 5 days, I'll do that on a 4-hour chart. If I'm looking for a day trade, I'll do that on a 5-minute chart. And then I'll go looking for the size, the real supply or the real demand, the real resistance or the real support on that time frame. So if you're not there yet, here's how you can fix that. It's the same fix I give every trader who asks me about this. Number one, pick the time frame, 5-minute, 4-hour, daily. That's the bulk of what I do. So pick one time frame. Find the institutional footprint. Find the volume. Use an anchored volume weighted average price. Use a Darvis and find that institutional volume plus the zone. Not just the volume and not just the zone, but the two of them together. I have a rule. Something and something else. Have at least 2 reasons. Then and only then do you start refining where your entry, where your setup might be. So once you've got your zones marked, the hardest part of this, the whole game, is in the waiting. Price trapping in that zone, right? You want to see price get in the zone and then revisit it. Most traders get impatient. They think the market's going to run away from them. The FOMO, fear of missing out, and they'll chase every single breakout. Institutions are counting on this. I've watched traders jump in the second prices break the resistance line of a buy or the support line of a sell, only to see price go right back into the range. So that impatience is going to hurt your account growth. What you want to see is how price behaves once it gets there. Is the buying actually showing up in that demand zone? Or is the selling actually showing up in that supply zone? If price just drifts through it on low volume, nobody's home. So the first test is to identify the zone and then wait to see if size is there. No one is in a winning trade all by themselves. You never have a winner alone. Part of a winner is more attention, which brings in size. And it's just a loop that keeps happening again and again. 2 candle patterns that can help you with this. I like minor highs at supply zones and minor lows at demand zones. I like inside candles at each one of those zones because it's showing a pause. That's really important. So zone, candle, pause. Now you're starting to see the and. Now you're starting to see how the setup gets put together. And that reaction is the confirmation, not the touch itself, the reaction to it, the respect for it. Every day I'm going to have trades that don't work for me and trades that do. And the ones that work cleanly are the ones where I waited for either the buyers or sellers to actually show their hand at these levels. And again, how do you say show their hand? How do you see it? volume, right? Always think volume. And I've watched the opposite happen. I like a zone so much, I'm as guilty as anybody, but I know to wait for the confirmation. Most traders who can't sit still are just going to jump in because, oh, there's something to do. Most of the time, the account growth comes in the waiting, in the patience, in the JOMO, the joy of quote unquote missing out. Getting in early can be the same thing as getting in wrong or incorrectly. Now remember, the reason this hurts so many traders is if institutions want to buy, they need to do so at a level where retail traders want to sell. Most retail traders are momentum chasers. Lower lows are going to get them in and higher highs are going to get them in. Here's a great example. When you look at the clearing range or the initial balance range every morning on an intraday chart, I do so on the 5-minute chart, the sweeps, that liquidity typically happens at the low of the clearing range and the high of the clearing range. The same thing happens again with the low of the initial balance and the high of the initial balance. If you're unfamiliar with that terminology, the clearing range is simply the high to low between 9:30 and 10, and the initial balance is the high to low between 9:30 and 10:30. So what happens? Those orders chasing the highs or chasing the lows, that's liquidity for somebody else's orders, usually the institutional sweeps. Smart money rarely tips its hand on the very first touch. It shows up slowly, right? It looks at where price is defended. And when you have low volume days, they love to pick off retail traders getting in at those obvious levels. That distinction, patience versus impulse, is where most of the damage to retail trading accounts happens daily. It's not their analysis, right? It's not that they're identifying different highs and lows. It's what they're doing. Okay, let's go back for a moment. What do you mean what they're doing, Rog? If you're looking at resistance and your thought is, I want to play the breakout of resistance, remember, someone else might be thinking, oh, we're going to stay in the zone, and they'll buy into that selling, or they'll sell into that buying, right? It's not the analysis that makes the difference. It's what are you looking to do at that level? Most retail traders are on the opposite side of institutional activity. So we want to wait for the confirmation because let's face it, none of us can read the minds of institutions. We work probabilities just like they do. So once that confirmation shows up, like I've talked about, what I'll do then is I'll cut the range that I'm looking at in half, because only part of the trade is how you get in. How do you get out? There's two targets. Once, say, a supply zone, a resistance zone is swept and price sinks back down into the range, at the 50% part of the range, I'll take a profit. At the opposite end of the range, I'll take another profit, because a lot of traders are pretty good at identifying sweeps, but they're overstaying their welcome and they're leaving a winner on the table too long, and it can sometimes turn into a loser. So targets matter a lot. Now, in all this discussion about intraday, I'm not abandoning the higher time frame. If I'm looking at a 4-hour chart or a daily chart, it's the same process. But instead of getting a new candle every 5 minutes, I'm getting a new candle every 4 hours or once a session. Now, I do not use multiple time frame confirmation. I know a lot of people love to do this. But remember, a 5-minute day trade can last 20, 30, 40 minutes. And a daily chart may not be really doing much. So remember, looking at a 5-minute and thinking because a daily is moving higher means that we've got a great trade isn't always so. Institutions are simply looking for those sweep levels. That might be something they're looking to take advantage of today. It might be something they're looking to take advantage of for the next 10 days. Use the time frame that coordinates with your time horizon. You want to be in the trade for 2, 3, 4, 5, 10 days? Use a 4-hour or a daily, not a 5-minute chart. So now you've picked your time frame, now you've found your zones, now you know what to confirm your entry with, and now you know what your targets can be, that 50% mark or the opposite side of the range. And again, targets should never be random, right? Just because it's a dollar amount. I want a $500 trade, I want a $100 trade. Those are random levels. We want to, again, use the chart to determine what the path of least resistance can be, where price is most likely to stop, where orders might start shifting. Pay yourself when you can, not when you have to. So now we know that institutions think of pools of liquidity, and those liquidity pools are typically what? Retail traders chasing momentum. Prior highs, prior lows, clearing range highs and lows, initial balance highs and lows. Those areas where obvious stops or orders are likely sitting. That's where they're aiming, that's where we're aiming. And then we look for volume to confirm that the institutions actually do want to get in on the action. Now, none of this works without risk management underneath it all. That's the foundation, and that's without exception. Every zone I've ever marked and failed at some point, and they will, are going to be where traders don't have volume, or let's say there was news and the volume got absorbed and the market kept going. Remember that every single trade needs a maximum level of risk to the account. I like to keep that at 5% or less. My average is about 3% risk per trade. You can go far below that if you don't want to go at 3%. Traders who survive in this business aren't the ones who found a magical indicator or a magical level or a 100% win rate. That's all tooth fairy, imaginary stuff. That's not the real world. The ones who size their risks, so when a zone does fail, are going to recognize the fail, have a percent based to account stop loss, and say, hey, I'm just wrong, and take a small loss. Those are the folks who survive. One of my traders asked me one time how I stay so calm watching a position go against me early, and the answer is kind of boring. I already knew before I got into the trade exactly what I was willing to lose. I came to terms with that. I accepted it, because if I don't accept it, I shouldn't take the trade, right? So that's why I'm calm. I've already recognized the worst case scenario. For me, that's getting stopped out, usually at no more than 3 to 5% account risk. And if you're trading options, I like to use no more than about 25% premium risk. This isn't about finding the perfect line on the chart and having a 100% win rate. It's about understanding who actually moves these markets and learning to stand on the same side of that trade, the one that institutions are on, instead of getting run over being their liquidity, like the average retail trader does. Structure will tell you where the real activity is. If there's an uptrend, I want to be bullish. If there's a downtrend, I want to be bearish. If it's chop, I'll find those supply and demand zones. Patience tells you whether that level is still relevant. Patience is what? The time to give yourself the confirmation, volume, the candle, even looking at time if you're a day trader. Risk management is what lets me come back the next day, even though I know I'm going to be sometimes wrong, without it costing me my account, without blowing up. I'd like to know what you're seeing out there. If you've got a level on your own, a chart that you're using right now that's catching your eye, drop it in the comments and tell me what time frame you're watching it on. I read through all of these more than people would expect. Once you're comfortable spotting these zones, the next layer is watching how orders actually behave inside them in real time. The kind of detail you can only see by watching order flow, watching volume, watching participation, and confirming it. I'll see you in the next video.